Well, we remain to be in a very bullish market, but the signs of things deteriorating keep continuing to grow, and it can get ugly, and it could get ugly fast. Today's video, I'm going to talk about some of the Fed concerns. We're going to talk about the JOLTS data that came in. We have some more stuff on the calendar later this week. I want to go over some big picture charts of looking at the yield curve with the Fed funds rate. We're going to get into some of the intermarket correlations and where they stand right now as far as shorter term to longer term. Look at some relative strength charts with the mega cap names. We're going to get into market conditions, which is incredibly important, because that will be the driving factor and the throttle of when you know to kind of ease up in these markets. And then we're also going to talk about the expected moves, which is what the market's pricing in for forward-looking risk going into tomorrow's trading session and where we stand on the week. If you like this type of content, the Stock Market Brief Show, make sure to subscribe to the channel. I try to get these videos out very frequently. And if you want to support me even further than subscribing, make sure to hit that thumbs up. It is greatly appreciated. And if you want to check out our Discord community, make sure to do that. The pinned comment is just below this video. Let's get into today's show. All right, everybody, welcome back to the show. So we did have that JOLTS data come out. We are going to touch on tomorrow, which is Thursday. We have ISM services, and on Friday we have some non-farm data. So I want to kind of dive into the JOLTS report and kind of talk about what the Fed concern is here and how things could kind of get ugly fast. Okay, September is the month where we do have a Fed interest rate decision. The market right now is pricing in about a 96% probability that we will have a 25 basis point cut. Is this going to be a one and done for the year? It's a potentially so, right? Because we only have about a coin flip for the other months. Now, we did have a lot of Fed talk today. Fed Waller came out, warned that the labor supply drop is masking labor demand weakness. We had Kashkari out too as well. Still too high for inflation, but the labor market is cooling. He expects soft landing and not a recession. And, you know, inflation, right, still too high. If I'm just using true inflation, it seems like we're going to be getting an uptick in the inflation read next month. So we'll see, or this month, whenever the inflation data comes out. I don't have that in front of me. But when we get that next report for August, are we going to see an uptick or above expectations? Well, true inflation since this last month has been increasing, so perhaps this might be giving us some insight into that next inflation report. If we take a look at the jobs data, JOLTS came out today, and think of this as demand for workers, right? Job openings has fallen, right? The lowest level that we've seen since September of the prior year. The hard numbers, right, fell by 176,000 to 7.18 million. And the opening rate flipped from, just slightly there as well. And if we look at the quits rate, well, workers aren't really quitting right now. So what does this entail, right? So we have job openings that dropped 7.18 million versus the expectations of 7.38. So fewer jobs are being advertised, right? Demand is falling. We have a vacancy rate, right, that slipped from 4.4 to 4.3. So fewer available jobs compared to the labor force. Quits rate stayed at 2%. So workers aren't quitting more, which can potentially mean they're less confident that they can easily find a new job. Why does it all matter? Companies are posting fewer jobs. That's a sign that hiring appetite is slowing down. The Fed's concern here is if demand for workers keeps falling and layoffs start to rise, it can set off a negative cycle. And that negative cycle is, well, fewer jobs can mean less income, and less income can mean less spending, and less spending can mean weaker growth, and weaker growth can mean potentially more job losses. So in short, right, the labor market loses momentum right now, at least, right? Fewer jobs are being offered, but not many people are quitting voluntarily. So the Fed is watching that closely, because if the slowdown in hiring turns into actual layoffs, it could snowball into a bigger problem for the economy. And this is where this chart from the thumbnail comes in, is because we are talking about the rate cutting cycle and bringing rates down. And if you just look here, this is the unemployment rate, right? Currently at 4.2. This is the federal funds rate down here. And what do you notice the unemployment rate doing in these areas that I highlighted? You typically see it raise. Now, if you just look down a little bit right here, right? What do you see that spike coming from? You typically see when we start cutting rates, boom, you see the unemployment rate tick off. When you start cutting rates, unemployment starts rising, right? When we started cutting rates over here, this is the dot-com bubble, boom, unemployment rose. Cut rates, that was the financial crisis. We cut rates over here, boom, pandemic, right? Consider that a one-off, but still, it fits within this kind of overlay so far. And now we're talking about, another 25 basis point cuts. And then some Fed members are speaking about many more to come in a shorter period of time. Will that potentially put some emphasis to the unemployment rate where we start to see more people out of a job? So I find that to be where things can get ugly rather fast. And if I put on another chart here, this is the big picture chart that I've been sharing for quite some time. This is the 10-year 3-month yield. This is the federal funds rate still down here. And typically when you move through an inverted state and uninvert, when the curve begins to actually steepen, right? This is a 3-month, so it's closely tied to the federal funds rate, which is kind of still, that's why we're not really seeing this steepen right now. Okay, when this starts to steepen, it's at the same time when we go through rate cuts, and this is what popped a bubble here in the dot-com bubble, right? And this is over here, the financial crisis, right? Obviously, many things happened throughout this time, but it's a very similar type look, even going down over here to the pandemic, right? We inverted, we uninverted, we inverted, boom. When we started to steepen and we started to lower rates, we went through all that volatility. Now we went through probably one of the largest and longest inversions in history on the 10-year 3-month yield curve, and we are now beginning to uninvert. We're at the early stages of uninverting this yield curve, and if we start to cut rates, right, this can very well mean that we're going to see this steepen, and if we start to see this steepen, it doesn't take a rocket scientist to look back and say, hey, careful over here because we've had problems occur. Now, you might say this time is different, and I'd say, okay, yeah, maybe so. But many times that we're in these areas when people were throwing out warning signs, right? That was also during the markets reaching up to new all-time highs each time here. So pretty impressive stuff. Now, this was the 10-year 3-month. You can also look at the 10-year 2-year. You are starting to see this steepen as well, and it probably has more to steepen. Now, if we continue on, the S&P 500 still remains in this bullish trend, right? Higher highs, higher lows. Ain't nothing really to worry about yet. Right? But as you can see for the last, few months over here, well, not really kind of like a few months, right? Just this kind of range in here, we've been kind of at, and we're at the upper bounds of it. So a couple of months, we've been just really sideways bound, but we are still managing to put in these higher lows and higher highs. You can even see the percent price oscillator has kind of just fizzled out fully. And the moves that are on the downside of this tend to have larger volume, where the up days are kind of slow, lethargic. And then when volatility all of a sudden strikes, freaks people out, and then it starts to eventually creep back up. If we start to look at the intermarket assets like the dollar, right? The dollar was down today, and this has been kind of flat to going sideways. And this is going to be important to pay attention to because the dollar's correlations is starting to get stronger on shorter term basis. And I'll show you what that looks like momentarily. The 10-year yield, you can see it's also a big down day today, down 1.54%. So we closed at 4.21 on the 10-year yield. And it kind of looks a little top heavy here, right? If I was just looking at this chart, we have a series of lower highs and kind of matching lows. So a break lower, perhaps. But are we going to break lower, or is this going to break higher? Well, once again, a very important asset to watch from an intermarket standpoint. You can see it a little bit cleaner on the weekly time frame, just how price action, right, is getting rather coiled up here in the 10-year yield. Oil was down big on the day, down 2.5%. And go figure, right? If your oil is down big, it's typically the 10-year yield has a strong correlation there. And if you look at all assets like dollar, 10-year yield, and S&P 500 altogether, you can see the dollar's been dropping, the 10-year yield's been falling, and well, guess what? That's been pretty positive for risk assets such as the S&P 500. So it's safe to assume, right, that if the 10-year yield bounces or the dollar bounces, that can still continue to pause out the S&P 500 or drag it down lower. And you can see that here by looking at the correlation chart. This is the S&P 500 up here. And then we're looking at the correlation it has to the dollar from a 15-day period. So this would be 15 days. This right here would be 30 days. This would be 90. Then I have 120 and 180 down below. And I'm just going to kind of focus in on the shorter time frame, but right here, we're getting minus 0.66, which just tells us that from a 15-day period, right, correlation, it's pretty negative here. It's not incredibly negative, like in the 70s or 80s, negative 80s. But what this is telling me from a shorter time period, that if the dollar bounces, that could put the pause out on the S&P 500. Now, if we take a look at how the S&P 500 is also related to the 10-year yield, right? Pay attention to the shorter time frame down here. It's also at minus 0.61 as well. So that is telling me, once again, that even the 10-year yield has this negative correlation that's pretty strong from a shorter time frame, that if it were to go higher, that puts pressure on the S&P 500 as well. Now, interesting enough, while this is taking place, gold, right? We're seeing a big move in gold. This one continued kind of outside of this range. I think it's getting a little bit of frothy here. Right, so to see this consolidate in the very near future, most likely going to happen. But yeah, continued move over here. So what really drove gold today, right? Was it the dollar falling? I don't know about that, and I can show you why. Look at the correlation that gold has to the dollar on the shorter time frame. There is no correlations. It's at minus 0.02, right? From a longer time frame, right, 180 days, it's at minus 0.96, right? And then over here, 120 days, pretty deep as well. So the longer term correlation is still negative. It remains negative. From the shorter term, however, there's not really a strong correlation. So, was it the dollar moving today down that really emphasized gold's move, or was it the 10-year yield? Take a look. Gold in the 10-year yield from a 15-day perspective, it's at minus 0.62. So if we're noticing here, that's a little bit deeper of a correlation. And as we previously stated, the 10-year yield was down pretty massively today. And being as that is, this could very well help out gold's move. So the dollar, not a strong correlation. However, if the 10-year yield now starts to move, perhaps to the upside, perhaps that also then puts the pause on gold. Just remember, the longer term correlations, the dollar is still deeply negative. So a falling dollar, falling yield would be a very powerful move for gold. However, if those start to turn back up, right, that could put the kibosh on the move and put it through some consolidation. If we take a look at silver, silver continues to break out too as well. And this one has a very, very strong positive correlation from a 20-day perspective to the miners, so GDX. Now, I'm pointing this out because if silver wants to take a little bit of a break, that means miners are too. I've short miners, and I've been pretty good with shorting miners. I shorted them right here, took a little profit, took a little bit more profit over here, and then got stopped out of the remaining. And I've done this many, many times of shorting miners. And now I'm coming to the point where I'm like, I'm probably getting ready to short them again and look for a little bit of a pullback and or consolidation given the context of this run. Okay, I'll continue on there and look at crypto. Crypto also up on the trading session today. This may be somewhat of a wedge breakout, right? But overall, right, I think the last time we kind of talked about crypto is we can see it potentially kind of come back into this range at about 115. But to just be cautious that we're still in a negative rate of change when you look at the 4 weeks between gold. So it's still a negative rate of change, which means it's a sell signal, sell trigger. We did sell off, right? We're bouncing back a little bit over here, and it still remains in an environment where we need to see this uptick. It's basically, in short, it's telling us that gold is outperforming Bitcoin, and that is a more risk-off type move. If we take a look at the relative strength between Meta and S&P 500, Apple, Nvidia, Google, Microsoft, Amazon, Netflix, and Tesla, there's something quick I want to point out here too, right? These, right, all the blue lines are the 50-period EMAs, and they were kind of trending up, right? Trending up, trending up, trending up. This one was flat. That was kind of Amazon, right? This Netflix has been kind of flattened, and then Tesla too. But a lot of these, right, being the Mag 7, they can move the markets. One call out right out of the gate is I want to call out Nvidia just crossed below the 50-period EMA. So this has been kind of weakening, and now it's getting us a little bit slower. But you can see over here, this was in May, right? This is in May, and this was getting above it. And from May to here has been a very good trade if you were prepared for Nvidia. Well, now that relative strength is starting to weaken relative to the S&P 500 since basically the month of August. It means the S&P 500 is outperforming Nvidia. Now, not only that, but Meta has started to slip under a little bit. And a lot of these, like Microsoft, is starting to flatten out and roll over. Amazon's kind of flat over here. Netflix, right, not really a market mover, heading down. And then Tesla also rather flat. The ones to now that are getting a little bit of attention would be Google, massive, massive move in Google. And then also Apple. And Apple has been on the radar. So we did have that Alphabet, news that came out, and that shot it up 9 today, which is just an insane move for Google to new highs. There's probably more steam in this engine, right? Like you can probably come up, consolidate. We'll see what it looks like. But just be aware that if you're just a new entry up at these levels, right, you can probably do a little bit better than that. At least wait for some consolidations. Apple, I'm still looking at around this 250. This is a trade that I took over here while price action was contracting and, pulling back a bit. And then we saw a nice breakout so far. I did sell into this, so I did remove some of my position in Apple, and I'm holding on to some runners. I haven't yet updated my stop. My stop is here currently, but I was planning on updating it to the low of this day. But I'm going to just give it one more day, see what it looks like, and then kind of go from there because my ultimate goal was to check it out at 250. SPY, this is pretty interesting. SPY, right? This is the kind of momentum trend indicator that I built. And it kind of gives you a look at the markets via trend, right? And tries to get ahead of a trend change. It gives you a rate of change. It's using multiple time frames, momentum, and so forth. And, the last time I talked about this on the big change was, well, actually the Q's change, but was over here on S&P 500 when it started turning green, when it turned positive. And that was the time, obviously, during all this volatility, people were up in arms about that. They're like, oh no, this is, the world's ending, blah, 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 whatever. Well, this told me to go long. The follow-through day told me to go long. We were talking about it all throughout then. And since that point, the market has been ripping higher and higher, more than pretty much anybody expected. Well, now, these last 2 days, I'm just calling out that it started to turn red. So now we're starting to get a momentum shift and a potential trend change. So I wanted to show you the history that, hey, 2 days prior to December 18th over here, it was red. It went down, it went up, it went down, it went up to new highs, and then it went through this, right? So it's not like it can't go higher, which it did over here, but just notice it stayed red for a while. Over here, it was only red for just a few days, and then it switched green down here, and then we started ripping right back up. Over here, you can see that we did go through some volatility so basically it was green, and then we went through volatility. It started to turn green, but then it turned red again, and then it started turning green right back again on that breakout. Over here, right, it was basically red. We went higher, it went down, we went higher, and then it started to turn green. So basically, it just kind of kept you out of this, of this period right over here. And then over here was about a 10% correction, right? This came down to about 10%, but it didn't switch green up until right over here before seeing a gap and go. And then the market really started to take off. So the only reason I'm pointing this out now is because is this mean, something bigger potentially might come? Maybe, perhaps, because momentum from larger time frames are starting to shift and slow down as well. And you can see if I zoom in here, you can see it's just been 2 days so far. So we'll see what that might, turn into. The Qs was one that I talked about not too long ago, and that's been red, right? So the Qs also turned red, and it turned red before the SPY. IWM, I believe, is still green, but this one has slowed down. If we take a look at the market's conditions, I want to view where we are in terms of the gamma flip line. The gamma flip line, for those that don't know, is incredibly important to know because when you're under it or when you're above it, your strategy, if you come up with some sort of strategy and it works really good sometimes and all of a sudden it doesn't work really good and you get confused, so then you look for a new strategy. Well, the gamma flip line is a way of determining, market conditions, right? That's one of my ways to determine market conditions. So I have strategies that work incredibly well under it and not so good above it, or I'll get less opportunities above it. But then when we're above the gamma flip line, I have strategies that work better above this, right? More swing trading, right? And then below it is more shorter term day trading, right? Maybe not even for the day, maybe just 1 to 2 days, maybe intraday, and so forth. Why? Because the gamma flip line, when we cross underneath it, what happens here is that selling will beget selling, right? But this is what, dynamic hedging takes place. You have vol control funds, you have CTAs. This all can be amplified under the gamma flip line and or change when we're above it. So under the gamma flip line, you'll have the market sell into selling, right? You'll have a buy into buying. So you get exaggerated moves. And this is where volatility increases. When volatility increases, right? What does that mean? It means risk, amplifies, right? Imagine trading the VIX, right? If your VIX, right, the VIX is at, 15, right, and you trade $100,000, we'll just say $100, right? Say if you have $100 and you're used to trading the markets with the 15 VIX. Well, if the VIX goes to 30, right now this is some backhanded math, but if it goes to 30, you can still trade this $100, but it's going to move like as if you had $200, right? Hopefully that makes sense, but that's what that would be like. So the gamma flip line, where are we right now? We're actually more in a neutral stance. We're right by it, which means what? We're not really having, aggressive delta hedging take place in the markets, but it's also a precarious place because if you start to break through and break higher, right, this can really bring volatility in, and then you have, vol control funds, help to increase that, right? The buy side in equities. And then you also have CTAs that can remain buyers as well, forcing the flows of the market back to the upside. However, if you start slipping just a little bit, things can get pretty quickly, abrupt as far as intraday sell-offs and potentially larger. And we're right there, just in that neutral stance still, right? We've been in this neutral stance, kind of in this range. In fact, I want to bring back up the range. This is ES on the hourly time frame, dating back a few months, right, to July. Okay, this is a big range under the 450, 6450 on ES. We've seen moves down, right? It got above it and then cracked and we saw a move down. It got above it, cracked and we saw a move down. And we're just basically right there, which is a very vulnerable place to be. So if we start slipping back under 6450, this still opens the door to all of this, where all this trade has kind of taken place in ES, but we've just been kind of holding on to it, trying to get through it and break away. And if you look here at the net gamma chart, 6,500 is this level right over here. That is the call wall, but traders are reaching out a little bit higher. This is for the SPX to 6,600. Now underneath that, we have 6,400 and then 6,350 and then 6,300 over here. And that would be considered our put wall. And these would be levels of potential support if the market started to slip further down. Now, the reason I want to kind of dive more into the volatility aspect of things is you can see this is the net gamma history chart, and all these white bars just tell us when we're above that gamma flip line, and then the blue bars down here are telling us when we were below it. And obviously, when we were below it, right through February. Mid-February, or sorry, the February 18th to about April 30th, what was the S&P 500 doing at that time? Well, S&P 500 and or Qs, right, through February, right, through, whenever I said, that was this entire volatile time where we saw big moves. That was in negative gamma territory. Okay, and you could see that by looking at the VIX. When we're in negative gamma territory, when we fall under the line, what is the VIX doing? The VIX takes off, right? We see it increase. So the other day, we saw a quick little pop up to and around 20, right? What happened? Well, we slipped under the gamma flip line and volatility rose. Now we're back above it and volatility is coming back in. So we're at that very precarious place. You got to be very careful, because if we start slipping under, things can move very, very quickly. CTA positioning still remains rather elevated. Same with vol control funds. They remain rather elevated. So this just tells me, once again, that they could be a little bit exhausted at these levels, but they can still be buyers. But if we start falling under the gamma flip line, that's when these things could pick up, and that's when things could get ugly very quickly. You can see over here in April, when they were buyers, we had all this pressure to the upside, right? Helping the buy side in equities. They had CTAs, boom, from April, from the lows. Over here, we were talking about what? We were talking about how CTAs can become buyers, and this could really help with the move to the upside. And now, once again, for the last month or so, maybe a little bit less, I've been just preparing people to let them know that we're nearing that gamma flip line. We're at the JPM collar, right, for the quarter, right? If I pull that up, where is that at? We're at that JPM collar, right? We went up to it, kind of came in, we came back up to it, we came back in, we came up to it, we came back in. We're just doodling around, and the gamma flip line has been moving up and moving up and moving up, and is putting us in this area where things can break very quickly. And by break, I don't necessarily mean bearish, but it can be bearish. But you can also see breaks to the upside here too, as price action's really just been giving us not much for quite some time, actually, right? As we previously discussed. Let's look at the expected moves. Now, this is what the expected move looked like going into today's trading session. We had the upper daily implied move for the day, and we had the lower one down here. It came into it, right? If you were following me on X, I said it's approaching. When it approached, we kind of backed off a little bit. And given the context of what everything looked like intraday, it seemed to me as if we would probably just pin around this level, given the context of 1 DTE options, market net flow, and so forth. Well, we came in, we drew down a little bit here, and then bam, we closed the day basically right back up at that pin. Okay, now for the week to day perspective, we tagged our lower weekly day one. Okay, so if you were prepared and you understood where these levels were, that's what the market was pricing in for risk, and we started to move from those levels. Now we're at that 5-day moving average. It's kind of flat to declining. We're above our week to date VWAP, and we're basically overall flat for the week. In fact, you can mark that LWC on your screen at about 645.04. That was last week's closing price. And you can see here, we're basically unchanged. Once again, that'd be the third week in a row. If we close around these levels, that we would be unchanged. We still got a lot of macro data out. It is very common to see us pull back to the lower implied moves to come back down there, but perhaps if the market likes what it sees, maybe we can try to press higher. It is very rare to see lows tagged and then a high tag, or a high tagged and then a low tag. So that's a lot more, rare, but it's not necessarily impossible. Now, going into tomorrow's trading session, our upper daily implied move brings us up to and around 647 to about 648.50, and then we have 640.20 to the downside, to about 639 to the downside. I have the exact levels there if you want to obviously pull them up. And yeah, that's all I got for you on today's video, everybody. Hope it helps out and kind of really gives you the insight of why things can turn ugly quickly. We use a little bit of the macro look and how labor slowing can potentially be a big impact, especially when rate cuts come. And that was just shown through the visualization of what it looks like with unemployment rate, moving higher and rates coming down and so forth, right? The Fed is typically late to these things, and they could be very well late again, or hey, maybe it's a one-off. Maybe this time is different and everyone's right, and we can sail off into the sunset to new all-time highs forever and ever. That would be just wonderful. But till then, right, I'm still going to manage risk. Hope that helps. See you later.